Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We are from Group 9, and in this video, we will be presenting about Islamic and conventional banking performance, a comparative analysis. Without further ado, let's start off with the introduction.
Banking isn't just about money, it's also about values and principles guiding how banks operate. So there are two major banking systems exist, which are Islamic and conventional. In the realm of global finance, Islamic banking has emerged as a distinctive and rapidly growing segment, offering an alternative framework rooted in Sharia principles. The fundamental disparity between Islamic and conventional banking lies in their underlying principles, operational modalities, and ethical frameworks. Conventional banking operates under interest-based transactions and profit-maximizing objectives, while Islamic banking adheres to Sharia law, which prohibits interest known as riba and mandates adherence to ethical and moral principles in financial dealing.
The principles of Islamic banking and also conventional banking principle. Islamic banking operates on principles derived from Sharia law, which prohibits certain financial practices such as interest, which is riba, and uncertainty, gharar. It aims to promote economic and financial activities that adhere to Islamic principles and ethics. Instead, it emphasizes ethical and Sharia-compliant transactions that promote economic and financial activities aligned with Islamic principles. Meanwhile, for conventional banking, it operates under a secular framework and is based on interest-based transaction. Where interest is a fundamental component of lending and borrowing, it operates within the legal and regulatory framework of respective countries. Moving on to the historical context of Islamic and conventional banking. Islamic banking traces its roots back to the early days of Islam, where principles of ethical finance were outlined in the Quran and Hadith. So these principles provided guidance on economic transaction, emphasizing fairness, justice, and ethical conduct in all financial dealings. So this historical foundation continues to shape Islamic banking practices today, guiding its commitment to ethical finance and social responsibility. Meanwhile, conventional banking has evolved over centuries, primarily influenced by Western economic theories and practices. Emerging from historical development in Europe and other regions, conventional banking has been shaped by principles such as interest-based lending, profit maximization, and risk management. Some key differences between Islamic and conventional banking. First is foundational principle. Islamic banking operates on Sharia principle, which prohibit interest, which is riba, uncertainty, gharar, gambling, maisir, and unethical investment, which is haram. While conventional banking is based on secular financial principle and not bound by religious laws or ethical consideration. Second is interest versus profit sharing. Islamic banking prohibits the charging or receiving of interest. Instead, it employs profit sharing arrangement where both the bank and customer share in the profit and losses of the investment. While conventional banking relies heavily on interest-based transaction, where interest is charged on loans and offered on deposits. Third is ethical and socially responsibility. Islamic banking emphasizes ethical and socially responsible investment practices, avoiding investment in industries such as alcohol, gambling, and weapons. Meanwhile, conventional banking may prioritize profitability over ethical considerations, prioritize financial return and shareholder interest, and may engage in financing activities regardless of ethical consideration. Four is regulatory framework. Islamic banking is governed by Sharia board and compliance with Islamic jurisprudence, while conventional banking regulated by secular financial authorities and law.
Bismillahirrahmanirrahim. So the differences between Islamic and conventional bank is not only limited to the previously mentioned aspects, but both banks also offer distinct products and services that differs in the aspects of their processes and also concepts. So let us first look in the context of Islamic bank. I will be sharing with you some of the commonly offered financial products that is offered by Islamic banks, such as musyarakah, ijarah, wakalah, and also sukuk. First is ijarah, or known as leasing. This product is typically used to acquire vehicles such as cars, where it is basically a contract between a bank and its client, where the bank acquires a vehicle on behalf of its customers, which then the client needs to pay the bank on a monthly basis over a specific period of time. And when the client has fully paid the cost of the vehicle plus its profit amount, and only then the ownership is transferred to the client. The second one is musyarakah, or partnership. It is basically an agreement made by two parties where each invested a certain amount of capital. Since Islamic bank practices risk sharing, so both parties shared profits or losses in a way that the loss is distributed according to the percentage of their investment, where in the case of gaining profits, it is distributed according to the amount that they have agreed upon earlier. So, musyarakah is typically used for residential loans, such as for renovation and also construction purposes. Next, wakalah or agency is basically when the bank or client works as an agent to carry out transaction on behalf of another party. For instance, in the context of murabaha transaction, it is where a bank invests money on behalf of its client to purchase needed merchandise. Although it is not widely accepted, but in situations where it is impossible to identify a physical asset or originator, sukuk can still be issued. Holders share returns according to specific ratio and experience losses in proportion to their investment. On the contrary, conventional banks only offered one mode of financing, which is loan. They are able to offer various types of products for wide ranges of customer segments with an underlying form of debt. For example, credit cards, operating finance, home and auto loans. Lastly, despite these products are offered to different customer segments, yet they can still be simplified as loan which bank extend to its clients. As such, credit card is a debt instrument, whereas a car lease financing is basically taking out an ongoing loan.
One of the differences between Islamic and conventional bank is profit and interest generation. In Islamic bank, they generate profit by engaging in profit and loss sharing arrangements such as wakalah, musyarakah, and mudarabah contracts. Other than that, they also invest in Sharia compliant ventures such as real estate, where profit are derived from the appreciation in asset values or dividends from equity holdings. The third one, they also charge service fees for various services provided to their clients, such as account maintenance, fund transfer, and advisory services. While in conventional bank, they generate profit through interest income derived from loans, mortgage, and other interest-bearing financial products. The second one is they also have fee-based income, where they charge various fees for services such as account maintenance, overdraft facilities, ATM usage, and credit card services. The third one is, of course, both conventional and Islamic bank accept deposits and use deposits to provide fundings to individuals and businesses. The difference is that in conventional bank, they charge a rate of interest to the debtors. Profitability is an important aspect in both conventional and Islamic bank, but they face different challenges in order to generate profit. In Islamic bank, they face risk sharing, where Islamic bank emphasizes risk sharing between the bank and its client, such as in mudarabah and musyarakah contract. The return on profit sharing is not guaranteed and depends on the bank's performance. If the finance taker generates profit from their business activity, they will share it with the Islamic bank according to proportion of bank's financing. If he suffer losses, the bank will share the loss also. While in conventional bank, they face credit or default risk, where the risk of financial loss arising from the failure of the borrowers to repay their loans or honor their credit obligation. Conventional banks face credit risk associated with lending activities, including the risk of default by the borrowers. Even though both Islamic and conventional bank have different of income generations, but only Islamic bank have the opportunities to gain on profitability, since conventional bank always gain profit from interest they charge. The first opportunities for the Islamic bank is infrastructure development. There is an opportunity for the Islamic bank to contribute to infrastructure development and economic growth by participating in financing projects such as infrastructure development, renewable energy, and real estate development can not only generate revenue but also strengthen relationships with governments and businesses, contributing to long-term profitability. The second one is diversification of product offerings, where Islamic banks have the opportunity to diversify their product offerings beyond traditional Islamic banking products like murabaha and mudarabah, developing innovative Sharia-compliant financial products tailored to needs of specific customer segments such as retail banking, wealth management, and corporate finance can open up new revenue streams and enhance profitability.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. I am Tutubi1103 Fatimah. I would like to explain about contributions of Islamic banking to public bank. Islamic banking contribute to public bank through several mechanisms: financial stability, ethical and social responsibility, financial inclusions, and lastly, economic development. First of all, financial stability. According to a study, Islamic banks often have a greater financial standing than conventional banks. This is because Islamic banking is based on principles that can result in more stable financial practices such as risk sharing and the prohibitions of usury. Risk-sharing mechanisms such as mudarabah and musyarakah ensure that both the bank and the customer share profits and lose, reducing the risk of financial instability. Second, ethical and social responsibility. Of course, Islamic banks operate in accordance with Sharia rules, which forbid engaging some immoral activities such as investing in tobacco, alcohol, or gambling. By adhering to ethical guidelines, Islamic bank promotes responsible and sustainable banking practices which benefit society as a whole. Additionally, Islamic bank often engage in philanthropic activities such as zakat, charity, which contribute to social welfare and community development. As Islamic banks are supposed to invest in business that follow Islamic law or develop new initiatives in the area of social responsibility, which means they have a significant role to play in social responsibility. This guarantees the advancement of human morals and the preservation of society from harm. Third, financial inclusions. Islamic banks cater to a wide range of customers, including those who may be undeserved or excluded by conventional banks due to religious or cultural reasons. Offering alternative financial services to meet a wide range of diverse populations. As a result, it can draw customers who would not have previously used traditional banking services, increasing financial inclusions and possibly supporting economic development. By offering Sharia-compliant products and services, Islamic banks ensure that individuals from diverse backgrounds have access to the formal financial systems. This promotes financial inclusions and empowerment, as more people can benefit from savings, credits, and other financial services offered by Islamic banks. And lastly, economic development. Islamic banking may support public banking by fostering economic growth in nations where it is practiced. According to a 2015 study by Imam and Kodar, Islamic banking can boost economic expansions, especially in developing low-income countries. This is because Islamic banking is based on principles that align with the needs of these economies, such as risk sharing and support for small business.
Assalamualaikum, I am Nurin. I will be explaining on the Islamic banking assets in global market. In 2021, Islamic banking accounted for over 70% or $2.8 trillion of total Islamic finance assets globally. To put this in context, throughout the 5-year period from 2016 to 2021, Islamic banking assets rose at a compound annual growth rate (CAGR) of 10.1% and are expected to reach $4 trillion by 2026. Furthermore, the industry had particularly strong growth in 2021, with assets increasing by 17% compared to 2020. Furthermore, according to Refinitiv data, there are already more than 500 Islamic banking in windows globally. There are 566 financial institutions, including 316 full-fledged Islamic banking and 250 Islamic window of conventional banking. This enhanced systematic relevance combined with diversification and growth outside a traditional Islamic banking region. It bode well for the future of the global Islamic banking industry. The Gulf Cooperation Council countries, the GCC, accounts for 43% of global Islamic banking assets, followed by other MENA regions, which is the Middle East, North Africa, by 40%. Apart from Bangladesh, the top 10 nations for Islamic banking assets were in the GCC country, the MENA countries, and the Southeast Asia, demonstrating that these three regions remain strong in Islamic banking. The top 10 nations accounted for 95% of global Islamic banking assets in 2021. Aside from Iran, the fastest growing market for Islamic banking in 2021 were the non-core nations outside the key regions of GCC and Southeast Asia, which is Tajikistan by 84%, Burkina Faso increased by 27%, and the Ethiopia by 26%. The GCC countries continue to be home to some of the world's largest Islamic banks, with 8 of the top 10 by assets in 2021. Some of these key players include Al Rajhi Bank, Dubai Islamic Bank, and Kuwait Finance House. Recent development in the Islamic banking sector stand out. First, consolidation occurred as a result of tightening market circumstances. The conversion of conventional banks demonstrates the continuous need for Islamic banking. For instance, on December 10, 2023, the Central Bank of Bahrain officially authorized the Ahli United Bank as a licensed Islamic bank. The conversion is the outcome of Kuwait Finance House Bank acquisition of Ahli United Bank Group through a share swap agreement in October 2022, making Kuwait Finance House as the world's second largest Islamic bank by assets. Second, there was some development in the non-car area, especially in Africa and Central Asia. For example, in Africa, it witnessed regulatory and market development advancement in Sudan, Libya, Egypt, and Ethiopia.
In conclusions, this research analyzed the differences between Islamic and conventional banking, focusing on the principle, operations, and societal impact. Islamic banking, rooted in Sharia law, prioritizes social justice, equity, and fairness in business dealings, fostering entrepreneurships and property rights. Conventional banking, on the other hand, focuses on interest-based transactions and profit maximizations within capitalist framework. Understanding these differences can provide valuable insights for stakeholders in the financial industry, enabling informed decisions that contribute to a more just and equitable financial system.
Alhamdulillah, we have finally reached the end of the video. That is all from us. We hope that this video will give you a clear overview of our project paper and benefits those who watches it, inshallah. Thank you and Assalamualaikum warahmatullahi wabarakatuh.